Another theme of our course that we will focus on are how do financial crisis occurs. So in this introductory lecture, let's just take a look at how briefly how the most famous financial crisis of this 21st century started to happen, right? So this happened actually in the US and spread to the rest of the world, beginning in late 2000s, right? And the origin of that was actually in the US housing market, right? So this is a picture of the national index of housing prices in the US, where we normalize the price in January 2200, and then we track about what happened to the housing prices. So you can see from here that beginning from January 2000 till 2006, basically the house prices kind of increased a lot, right? In fact, they more than doubled. And after that, kind of like house prices started going down, right? And then they stabilize and then they have later movements, right? So you actually had at this period basically a large decline in housing prices, right? So already when this decline in housing prices started happening in 2006, analysts had already anticipated that this would lead to a decrease in demand and a slowdown in growth. Why is that the case? Because houses are basically an asset which are an important part of different people's assets, right? So therefore, whenever you have got a reduction in the price of a asset that you hold, basically you are poorer in some sense. And so that's why kind of people already anticipated that as a result of this, there would be a slowdown in the economy, right? However, what very few people kind of guessed at that point is that this would lead to a major macroeconomic crisis, which would kind of like bring the economy on a to near collapse situation, right? And what the analysts missed at that time was actually thinking about the effect of this housing market and about how this tied in with the economy as a whole, right? So this is one development that has happened more recently, I would say, where you kind of like start thinking about what's the effect of the financial markets versus the real markets in some sense, right? So Wall Street and Main Street, how are these connected, right? So that was the more jargon that is used, right? So we'll kind of like explore some of these elements when we discuss financial crisis, but let's see how this particular episode played out, right? So first question to think about is that why did we see a price increase in the first place in this housing market, right? And that was basically considered a result of two different developments. One was the interest rate environment that was prevailing at that time. And secondly, the innovations that were happening in the financial products in these markets, right? So interest rates in the early 2000s had actually come down a lot. And what that mean was that it was like cheaper to get housing loans, right? And as a result of that, there was a lot of like demand for housing, and this led to increase in the housing prices over time, right? And the second thing that happened, this innovation in the financial products, was that you had some new financial products coming in, such as subprime mortgages. And that actually allowed the expansion of loans to more risky borrowers than was done previously, right? So because the set of people to whom you can extend the housing loans increased, as a result of that, the demand for housing increased, and that is what led to an increase in the prices, right? Now, as long as this kind of like house prices kept increasing, these developments were not considered problematic, that you are kind of like giving loans to more and more riskier borrowers. However, house prices did start going down from 2006. And as a result of that, what happened is that the value of mortgages, so what are mortgages is, I basically think of this as the housing loans. So the value of the housing loans that kind of like people had, that started exceeding the value of the house that they had, right? So they kind of like were now paying much more compared to the assets for which they were paying, right? And this housing loans also turned out to be riskier than what the borrowers had understood them to be. So they kind of like, at what rate would interest rates kind of like go up and so on, right? And as a result of that, many borrowers actually ended up defaulting on these housing loans, right? So this is the situation related to the housing market. Now, how did that translate into a economy-wide crisis? So basically, there were three elements that were kind of like important in thinking about the effect on the financial system, right? So these elements were high leverage, illiquidity of assets, and liquidity of liabilities. Again, don't worry if you don't understand these terms now, just try and get a big picture overview. We'll discuss these different aspects as we move on in the course, right? Now, in 2008, all these three elements were present in the financial system. Why was there a high leverage? Well, the banks, which were kind of an important financial intermediary, they were very highly leveraged, or what that means is that they had a lot of debt on their portfolio, right? Why were they highly leveraged? Because, well, they underestimated the risk that was there in the market. The managers were also incentivized to take up high expected returns project, right? So as a result, they kind of like took out more loans to kind of like take up these projects. And also there was a development in the kind of like this financial sector, which allowed banks to sidestep a lot of government regulations that were there through creating something which is known as structured investment vehicles, right? So what were these SIVs or structured investment vehicles doing? So on one side, they were borrowing from investors in the form of short-term debt. What does short-term debt mean? It means that the loans which have to be repaid very quickly, right? These are not like, you have to repay them over many periods of time, but perhaps you have to repay them in a matter of months or weeks or so on, right? And the other thing that they were doing is that they were holding on to various types of securities, right? Now, what was the purpose of creation of these SIVs? They basically allowed the banks to get around regulations about how much risk you can take, right? Then in that case, why were kind of like people willing to give money to these SIVs? Because they actually had a guarantee from the banks that created them that if needed, the banks would step in and provide funds to SIV if they were unable to pay back the loans, right? So this allowed the banks to kind of get around the regulatory requirements and take on much more risk that was there. Now, what happened when this house prices started falling and these house loans were being defaulted on was that people started questioning, will SIVs be able to kind of like, repay back the loans that they have taken? And once there were questions about the solvency of SIVs, there was new questions about, about the financial health of the banks which were backing these SIVs, right? And another development that happened at this time was this growth of securitization, right? Now, if you have got that banks are only making loans locally to different entities, then a fall in house prices locally would just lead to this banks getting in trouble, like this local banks getting in trouble. However, if you had banks which had portfolios consisting of mortgages or housing loans from different parts of the country, then this banks kind of like would be in more trouble, right? So one such example, which actually led to banks having portfolios which resulted in them giving out housing loans, not just to people in their locality, but to people all over the country, was this development of this mortgage-backed security. So we'll again take a deeper look at this object as an example of financial engineering kind of gone wrong, but for now, just treat it as an object, right? So what this kind of like asset mortgage-backed security did was that it led to kind of like banks actually kind of like paying out to very different kind of like entities. And then the bank started paying less attention to whether the borrowers could actually repay or not. And it also led to rating agencies incorrectly assessing the value of such securities. We'll see later on why that was the case, okay? So the end result was that because of kind of like this, they took up much more risk than they thought. And when house prices started declining, investors started becoming reluctant to kind of like hold this mortgage-backed securities or to continue to lend to SIVs which held the securities. Remember that SIVs had on their asset side of very different types of securities, of which a major portion was this mortgage-backed security, right? Now, so as a result of this, kind of like you have got assets which are such as mortgage-backed securities, which these banks and SIVs are holding, but nobody is willing to buy them at this point, right? Because now there is a lot of uncertainty about what is the value of this asset. And as a result of that, the banks and SIVs are finding it very difficult to sell it off unless they are willing to sell it off at like much lower price than what they had valued it at, right? And so this is the second element that we mentioned, right? Remember, we mentioned that there are three things which caused combination of three things which caused this intensification of this crisis. You had high leverage, illiquidity of assets, and liquidity of liabilities. Where is this liquidity of liabilities coming in? So another development that happened was the rise of the wholesale funding, right? So banks relied on funding from other banks or investors in the form of short-term debt, as we mentioned, and SIVs were in fact entirely funded through such wholesale funding, right? Now, what happens is that if you put in your money in banks, then kind of like governments provide you some insurance, right? If the banks kind of like fail, then some amount of your money kind of like are protected by what are known as deposit insurance, right? The problem was the people who had invested in SIVs, they were not protected by any such insurance scheme, right? So they feared that if this SIVs declare bankruptcy, all the money that they had kind of like lent to these SIVs, they would be getting none of this money back, right? So then they kind of like started becoming concerned about whether the SIVs would be able to pay it back or not. So that resulted in kind of like them not willing to extend any further loans to these SIVs, right? So in fact, they started asking for their money back, right? So you have got this combination, this volatile combination of high leverage, liquid liabilities in the form of wholesale lendings not being covered by deposit insurance, and illiquid assets, such as this mortgage-backed securities, which actually contributed to the financial crisis. So the high leverage led to a sharp decline in the capital of banks and SIVs. This led them to sell some of their assets. Because the assets were very complicated, firms had to sell them at much lower price than what they had valued it at. And this, as a result, led to further decreases in their assets, right? Because they had to write down the value of these assets. And investors also became reluctant to lend money to such SIVs and banks. So this is how the fall in the housing prices led to kind of like problems starting to come up in these SIVs and banks and the financial intermediaries, right? Now, what was the consequence of this? As a result of like not much kind of like loans being kind of extended, that created pressure on all the other loan markets at the same time. And that resulted in large increases in the interest rate at that time, right? Now, this was problematic because people kind of like rely on loans for doing a lot of things, not just engaging in speculative behavior, right? So if you want to take out housing, or sometimes if you want to do education loans, if you want to kind of take out loans to borrow so as to kind of like spend it on durable goods, all of this is like problematic now, right? So it increased the interest rate at which not only people but also corporations and firms could borrow to finance their investment projects. And it also resulted in a large reduction in confidence about the future, right? So people became reluctant to spend about the future because they were uncertain about, okay, how big is this crisis? Are they going to lose all their jobs? And as a result, they started saving more. And this basically kind of like ended up creating economic crisis in the sense that this resulted in a reduction in consumption as well as investment, right? So you had lower confidence about the future. You had stock prices being affected by kind of like the banks being in trouble and the larger economy being more uncertain. And you had lower housing prices, which resulted in lower wealth of the people, right? And that resulted in a reduction in aggregate consumption of the economy, right? So this fall in aggregate consumption and aggregate investment resulted in a reduction in total demand in the economy, and that is what led to the crisis. So what were some of the responses? So one thing that the government did is that they extended this deposit insurance not just to people who have money in the savings account, but also to people who have extended loans to this SIVs, for example. And the Federal Reserve, which is the central bank in the United States, that also provided liquidity to the financial system, which made it easier for these banks and other financial intermediaries to borrow. Remember, one problem was that this loan market for loans had just frozen up, right? Nobody was willing to lend to anybody else because they were uncertain about whether they'll be getting back the money or not. So the government stepped in and made it easier for these banks to kind of like take out money from the Federal Reserve, right? The government also introduced some programs whose aim was to remove these complex assets, this mortgage-backed securities from the bank balance sheet, right? And this was later on used to increase the capital of the banks. There were also changes that were done in the monetary policy and the fiscal policy. So we'll discuss these things in detail later on. But basically, the Fed has an effect on the interest rate in the economy, and they took actions to reduce this interest rate so as to make it easier to kind of like borrow, right? However, there were like problems that also happened in the monetary policy domain that led to a lot of like innovative strategies and non-standard ways in which the central bank tried to intervene, right? So these are what are known as unconventional monetary policy. And the government also resorted to what is known as fiscal policy, right? So again, these are terms with which you may not be familiar now, but we'll discuss later on. But these are basically kind of like the policy instruments related to taxes and also increases in government spending. The whole aim was to kind of like, compensate for this reduction in demand from the consumption and the investment side, so as to increase the demand and to kind of like stabilize the economy, right? So this, for now, just think of it as a case study of how you have an interaction between the financial sector and the real sector, if you like, of the economy, and how that interaction can actually sometimes lead to the economy kind of like being in trouble, right? So because people had kind of like not understood how well these two kind of like things are interlinked, that led them to kind of like a lot of people not able to see this sort of financial crisis that developed, right? So as a result of this, a lot of like research has been going on in the last couple of decades, which have like enabled us to understand better. And we'll discuss some of these other aspects related to financial crisis as we kind of like move further in the course. But for now, just think of this as a useful, hopefully, case study to learn.